Hey Trader Stephen here. It's Thursday afternoon, July the 19th. We've got a lot to go over. We're going to go over the market, but today we're going to go over a lot of individual industry ETFs, find out what's strong, what seems to be perking up, and which ones I'd probably avoid. So I want to start with normally I start with the NASDAQ. I want to start with the S&P 500 because it looks a little bit more interesting to me as far as being predictable. It's in this upward channel, right? It broke out of a descending triangle, okay? And if I were to draw that, let me get this off here. Well, I'm not going to draw it, but it broke out of a descending triangle right here, came back, found support, and is now in this rising channel. Still in the big box, right? Still in this consolidation. The NASDAQ has hit an all-time high twice since this waterfall. The S&P 500 has not. S&P 500 just now clearing all of these 2,800 levels of resistance. You have 1, 2, 3, so that seems to be bullish. If you look down here, one thing I want to look at on the S&P 500 chart, if you look down here, you can see that it's now forming this pattern, right? It hits this upward channel, comes down, finds support at the trend line, and just kind of pinballs back and forth. So if we play the overbought, oversold, it's actually really simple, at least at this time it is. You can see right here, it's overbought, comes down here, gets oversold, comes back up here and right up here to the upper end of this channel, and it comes out of the overbought stage, goes into the oversold stage, comes out of the overbought right at the top. So you can see my point of this exercise is just to show you right now as it's coming out of the overbought, the last 1, 2, 3 times as it was hitting the top of this trend line, and now it seems to be coming out again. So am I saying this is bearish? No, but I'm just saying that if this pattern holds, if it continues to kind of grind its way higher, then it's reasonable as it's coming out of this overbought to just ease a little bit. And the moving averages, I wouldn't call it in rally mode unless it comes down and finds support at the 20-day moving average. But the moving average just hasn't really been working that well with the 50-day moving average. So then you find the pattern that does seem to be working, and right now we're coming out of the overbought. So maybe it eases a few points. Couple bullish things I want to keep noting on is Tuesday will look like it was going to start pulling back, and then it just reversed higher by the end of the day. That's a positive. Close in the upper end of the range. Wednesday is at the top of the range today. So even when we have down days, if the market closes in the upper end of the range, I would consider that bullish. So if it eases a little bit, I'd consider that more of a setup and an opportunity. And then if it starts to break these 2,700 levels, which you can see that it came down to twice, then it starts to get a little bit more interesting to the downside. What's really interesting is, and we're going to talk about this, how much the international markets and the U.S. markets are diverging right now, where the U.S. markets are, they're in a bull market. NASDAQ's at an all-time high, Russell 2000 strong, S&P is about there. Emerging markets and international stocks are just getting slaughtered right now due to the rising dollar. So, there's a big discrepancy right there. And even today, if we go look, so that's the S&P 500. If we go look even today at today's price action, you can see the Russell 2000 is incredible. The small caps are a lot stronger than anything out there right now. You get the TSX, that's the Canadian exchange, but anyways, are a lot stronger. But when something starts down up, now we'll have to see where it finished, but when the market starts down and then closes in the upper end of the range, I find that as more accumulation than distribution. So we'll just kind of continue to have to play it. But right now on the S&P 500, I am really looking for the first level of support. Whoops, that's not the chart I wanted to go to be around the 2740, 2750. I would say that it is going into more of a correction mode into the 2700 if it breaks that. Now, it's important to note that most pullbacks when you're in a bull market are just pullbacks. They don't enter that correction territory, and identify a pullback as anywhere from a 3 to 5% normal pullback. And now it doesn't seem normal when it's pulling back, right? Like this to me, I thought it was going to crack, and it didn't. So it's just kind of important to keep in mind that if you pay attention to the stocks that you own, if they're getting slaughtered, then you can kind of pay attention to the breadth, and you can start to be worried. But right now, we're in an uptrend. It's not the best uptrend. It's not a rally uptrend, but we are in an uptrend. So I think you just have to play it to the upside. Looking at the NASDAQ, broke an all-time high right here. And Tuesday was interesting because it just finished way lower. I thought it was just going to crack. It was going to come down here, and it did not. It found support right at that 77.50 area, finished at an all-time high, continues to kind of ease a little bit. So could this pick up some steam to the downside? Yes. Is there a trend line right here that comes probably up to the 7,600 area? Yes, that's about 2-3% away. So again, every time the NASDAQ if this is the start of the waterfall in January, then reach an all-time high and start pulling back. Now you got an all-time high right around here. It went a little bit longer and then it pulled back. Now you get an all-time high right here. So the time to buy, and this is hard for me too, is really when you get an oversold, not an overbought. So it's something, especially when you get into more challenging environment, sometimes the hardest thing to do is to buy when the market gets oversold. But when you get into more challenging environments, you're going to get shaken out probably a lot more times if you're buying the overboughts instead of buying the oversolds. Just word to the wise there. I want to look at the CRB2. Okay. So we've been tugging and pulling, and I've been talking about this for a couple months. Which way is it going to go? Is the dollar going to break up, going to get through this resistance, or is is it going to find resistance and break down and then commodities soar? To me, as far as I'm concerned, we have our answer. That doesn't mean it can't whipsaw us the other way, but I was seeing a lot of signs that were pointing to the dollar cracking right here. Miners were starting to act good. The relative weakness in the small caps relative to the large caps started to get weaker right as the dollar was entering this zone. So there was, and the miners were outperforming the metals. So there was enough evidence to suggest that the dollar could at least see a retracement, but it just didn't happen, right? The CRB commodities, it came down, touched the trend line, tried to bounce, looked like a reversal, which is even more evidence. It's kind of a bullish, looked like a bullish bounce, and then it just cracked. So in my opinion, at least this year, this round, the dollar has won. So I'm really trying to be cautious, especially with gold. Gold was looking ripe a couple weeks ago, and now not so much, and we'll look at that here in a second. But the dollar is moving. That should be bullish for small caps, as the evidence suggests in today's market action in the outperformance. So it's just really interesting, and we'll just kind of go to that real quick. And I know I've shown this chart a lot, but you have on a weekly chart, you have the US dollars is breaking through this area right here today. Just look at this leadership in the small caps relative to the S&P 500. It is just surging higher, breaking out at the same time the S&P is breaking out to international stocks and just smoking emerging markets. You have a death cross going right here, and if we haven't had a death cross in this yet, we are there any day now. So it's really not looking good for international stocks. Yeah, so this is emerging markets. It broke a 2.5-year up trend line right here. You got the death cross. Boy, I don't know, but I don't want to be in the way, standing on the tracks if this thing starts to go down. It looks like it's ready to take another leg down. Could it take another leg down, or could it just start basing? I don't know. But, follow the strong, not the weak. And this just right here doesn't look very strong to me, so I'm going to follow, U.S. stocks. Smaller cap names seem to be outperforming right now. If we want to look at GDX, which I just sold a position because it just wasn't working, there's a lot of evidence to suggest that the gold miners trade could start working. Gold miners broke out, GLD was at support as the dollar was at resistance, and GLD broke support as the dollar is breaking out. Not on the same day, but you know, it's seen. And if you come down here, you can see the miners to the metal, it broke out. So when miners are outperforming, according to Greg Chenault's stock charts, that's when you want to be long. Well, it doesn't really look like I want to be long right now because it broke out and now it's kind of starting to go the other way. And I drew this trend line right here too. So you have the miners breaking out relative to the metal right here. It went up and then shake out. So you have the GDX. Let me get the volume off it because I don't. Where is the volume? Let's just kind of update that. So you have GDX continues to just be in this just major trading range. Always seems to find support around 21, 25. I don't know if you could say it broke another trend line right here, but you know, gold miners went from looking strong to looking weak. So that's just part of it. Especially when you play a trading range, you have to understand that even though all the stars are aligned, it happens several times and then it rolls over. So that's just one reason why I don't like to just buy and hold commodities, even though from an investing standpoint it could make sense. Because you can see right here, this is a 2.5-year chart. You can see that the miners have not gone anywhere since the middle of 2016 or the fall of 2016. Have been under this 25 level, between kind of this 20 and 25 level, just pinballing around, going nowhere. Though from the looks of it, the fact that this breakout didn't work, man, it looks incredibly vulnerable to the downside. So, but it could just hit that 21, 25 area and just continue to find support. But, you know, right now I'll just kind of move to the sidelines and ignore it for a minute. I want to focus on, or I want to show one more thing, is that's the marijuana ETF. Now, there probably wasn't many more people that were excited as me about this sector because, you know, it broke out of this downtrend. If I could just draw a trend line right here, you know, Canada is going wreck, everything. You could draw right here, you could draw right here, but it's breaking out either way. And, you know, it's kind of creates a consolidation, breaks out, finds support, and it just rolled over. So we played some marijuana stocks, and I think we made money on all of them right in here, but they kept going up and just coming back and hitting our stop on our second half of our shares. And then you just had the crack wide open, and it's looking ugly. Maybe it comes in and finds support right here, but I'm looking at a lot of the marijuana stocks, and they're not looking very attractive right now. This is pretty ugly market action, and I really like the industry long term, but you know, if I'm looking for swing trades right now, I'm not really looking here just because I don't see anything. I don't see high probability setups. I'll put it that way. No, let's just not save this. I want to look at the sector summary, and then I want to look at some individual industry ETFs, just about 25 that I follow. Let's just kind of thumb through them and see what I'm noticing. So it was really interesting. Oh, I want to look at the XLF here. Whoops, we'll go to that here in a second. But the financials kind of were in a descending triangle, and we'll look at that chart here in a second, but broke out, was looking bullish. Now all of a sudden they're getting slammed and utilities are up. These two suckers are probably going to move in the opposite direction. So now we have the tug and pull in interest rates, and I'm sure the dollar has something to do with that too, as it always does. But I'd say the dollar beat commodities, and now we're kind of looking at interest rates. If financials can head higher, I think that would be incredibly bullish actually, let me look at a picture of the XLF real quick. If financials can head higher, I would say that is definitely bullish for the market. You can see that it's in this descending triangle, looking vulnerable to the bottom, kind of created just a little mini flag, broke out, had some follow through, broke out of this downtrend, and is pulling back pretty good today, down 1.25%, which given the market is not even down 0.25%. That's interesting. So maybe it comes and finds its footing, comes back and retests this area, but right now I'm bullish, but I really like to see financials get a little bit stronger because they're a nice chunk of the market, and they have, on a relative basis, they've underperformed everything. So I think this breakout to hold would be important to help move the markets higher. But tech stocks continue to show strength. We'll look at that here in a second. But financials are, oops, let me kind of go back here to the sector summary. Today, utilities are leading, but you can see right here, I want to look at the perf chart. Get that off. Let's look at the last 5 days. Okay, so look right here. So in the last 5 days, through the 18th, so through yesterday, the money's been flowing in the financials. This would come down a little bit, but financials and industrials are leading, which is interesting because they've been the lagging industries for a while. And utilities have been lagging with energy and materials. So this probably flopped a little bit today, but financials have been strong. So the last 5 days, there has been money flowing into them. And in the last 10 trading days, the money financials continue to dominate. So again, I see that as a positive sign. I'd like to see financials dominate. Sometimes money just flows. Sometimes these can flow together, and they don't always correlate negatively. Sometimes money can just flow into the utilities just because they're getting ready for, the summer months. Selling what may go away kind of thing. So you'll see these utilities pop a little bit, going more conservative. But, technology is still up there. Industrial strong. For the last 10 days, I would say is definitely been bullish for the most part. And you can see utilities and staples have been lagging. Looking at the S&P 500 chart, coming out of the oversold. And I always don't, unless I can find a very specific pattern, I typically don't always play the overboughts or oversold. But right now, I think the S&P 500, it is in that channel, and I'm going to respect that until that pattern breaks. So let's look at the S&P 500. Oops. Excuse me. Let's go to EEM. Okay. So I want to go to the last 252 trading days. No, okay. So it's interesting, and this is the last 252 trading days. This is the last year. There's 252 trading days in a year, give or take a day. Actually, no, I think that's right. But it's just really interesting to see when the leadership changes, and it has, the S&P 500, I mean, these things went in the opposite direction in early May. So when the S&P started to break out, the emerging markets and international stocks did not, and that's, the dollar has been strengthening the U.S. stocks, or it could have just been weakening these. But my point is, this visual should be all you need to know that you want to be in the strongest ones. It doesn't pay, because I've seen these relationships can stay out of favor for years. The difference between 13.5% and 5%, I mean, depending on your portfolio size, could be a significant gain, and then compound that for years and years to come. And I'm sure you can do the math and get the picture where I'm getting at. My point is, focus on the strong, not on the weak, unless you see some serious turnaround signs. Okay, so I want to go through some industry ETFs, just talk about where I see some opportunities. I'll start with what's strong today. MLP, actually, let's just see where the volume's going. MLP, oops, I had that locked. Okay, let's try that again. There's a lot of money flowing into the MLP ETF, and there's a lot of money flowing out of metals and miners. Yeah, that's kind of where it looks like to me. So let's kind of focus on price today, and then let's go from here. This MLP really does look interesting to me. One, because MLPs are still not even close to where they were at back in 2014. Still way down, but man, so you have a weekly reversal pattern right here. You have one right here. So this one went up, would have worked for a little trade. If you'd have taken some profits, and then you have another one right here. A lot of times you'll see this. So as you get into multi-year bear markets, you'll have these, where it's coming down. You got the death cross right here. And then what will happen is you'll get these bear market rallies, and then it'll start to stay above the 10-week moving average. But if that 10-week hasn't crossed above, and I have a complete webinar on this, if the 10-week hasn't crossed back above the 40-week moving average and that bear market rally rolls under the 10-week moving average, you need to get out. Because I've looked at these, and you get this bear market rally, then it rolls over, and then you got a rally, and then it just cracks. So, and then you have one that works, and you can see right here at the bottom, you have a rally. It starts to rally above the 10-week moving average and never closes below it until the death cross. So, yeah, it just had this major rally. So, if you're ever wondering, you know, if you're in an industry or in something, I would say as far as sectors and indexes, I wouldn't really say individual stocks, although you could do it with individual stocks too. But when you know you're in a bear market and then you start to get that rally and you're trying to get a good price, and then it just starts to really even break that trend line or roll under the 10-week moving average when the death cross is still in play, likelihood of it just cratering back over, I think, is high. Just based on the charts that I've seen, because then you can see one that works, and it does. So, and then it's still, but this one worked, but it only worked for so long. Now, one could say if you bought it down here, you still would be in the money, collecting an 8% yield this whole time. But here's one thing that interests me on this MLP chart. You have it rallied and then couldn't really create a base above the long-term moving average and then rolled over. And now it rallied, and it created a pretty good box right here, I would say. Oh, that's not really good. I'll just kind of draw a line pin, but it kind of created a really good box right here. And I think that's a long enough pattern to consider it valid. The longer the pattern, when it breaks out, to me, the more valid it is. And now you have it popping today on huge volume. Now there are 2 MLPs today I noticed that are, well, there must be some buyout news. So it might be moving the whole industry, but it's happening. It's moving. And on this one, you didn't really have, this is too short of a base, in my opinion, to take it the bottom seriously. But now you have it's trying to, it failed, and now it's trying to come back. So am I saying this is going off to the moon? No. But I'm saying if you're a dividend guy, and I keep coming back to these MLPs, yeah, weekly reversal right here, and now it kind of coming back. It got rejected at the long-term moving average and coming back. You know, if 7.8% yield, what am I going to say? So the REITs right here, this real estate investment trust, nice yield, but to me this is, I'm more looking for kind of a consolidation and a breakout, because yes, you have the golden cross right now. REITs made a really, really nice move as yields are pulling back, but these are probably going to move the opposite of some financials. So very interest rate sensitive sector. We'll just kind of have to wait and see. Retail is coming out swinging. So the longer the base, the higher in space. Just one thing I'll never forget. Look at this base. This whole industry has been out of favor since, what was that, the beginning of 2015? It's 3.5, 15, 16, 17, yep, 3.5 years. That's really interesting to me. So when you have, and if we go to, once some of these industries, they go on multi-year runs, and you can see retail was very, very strong. It went from 10 to 50, this ETF, and it's pretty much been basing for 3.5 years. Man, I don't want my money to be tied up for 3.5 years, but now there's an opportunity, if this breaks to an all-time high, out of a 3.5 year base, and this is a monthly chart, you could probably even argue that it goes back to even longer. You could probably argue that this base goes all the way back to 2012, which is an even longer base. that to me is interesting. And then when all of a sudden something starts to wake up and starts to outperform on a relative strength. So you can see if we're on the monthly chart from a relative strength point, pretty much since the fourth quarter of last year that retail has started to turn around. So, or has started to outperform the overall market as a relative strength. It's getting close to an all-time high after going nowhere for 6 years. That to me is significant. Actually, I want to, now we have utilities. So you have this nice run. And I'm going to look at longer charts right now just for a second. So you have this, let's just play this game. So I can make two cases for utilities, okay? You have these multi-year runs, and then the trend line breaks, and then it comes down and tests it, and it rolls over. All right, well, guess where we're at right now? You can draw this trend line in a different place, but I think you'd be hard-pressed to say it didn't break, okay? A break, and now is retesting the trend line. Does it roll over from here, and do interest rates go higher? That's one argument. The other argument is on the bearish side, or excuse me, on the more shorter term picture. I mean, it cleared, you know, this 52 level, utilities are, and they're looking pretty strong. After going sideways, going nowhere for a whole year, all of a sudden they just made a major surge and are now kind of living above the long-term moving average. So this is one that I think the interest rates are going to matter, but from a long-term perspective, I would say it's bearish. In the short term, I would say it's bullish. Maybe in the summer months it's bullish, in the long term it's bearish because of the interest rates. We shall see. It's not going to happen overnight, but again, utilities are perking up out of nowhere after really, and they're still in their death cross mode. Wonder if there's a on the weekly chart. So it's still in bear market, but now it's creating a flag on top of a base. So you have to respect it in the short term. Let's go to home construction. Home construction is made a really nice move on Tuesday, up 2.3%. That's a pretty big move for just, you know, home construction. And then it got hit a little bit, but you can see it closed in the upper end of the range and now is turning around, is pretty strong today on a day when the market's down. So we own a home construction stock. I'm hoping that that plays out correctly. But from an industry ETF standpoint, now this is a descending triangle, so that it could be a continuation down, but it's breaking out. So when it starts to break out and I'm seeing some buying stepping in, I'm interested. Medical devices, it's a boring uptrend. It really is. Holy jeez, I wish I would have bought this thing a long time ago. And it's just part of technology and everything that is a part of this culture and the movements of, you know, the advancements that we're having. I think this could, you know, be in favor for a very long time. Now you'll have periods where it's not, but it's one of the strongest ETFs. The XOP ETF is looking volatile, to put it nicely. So you have a, you know, oil peak back here with commodities. They have made a nice run. We played some oil stocks and they did okay. So right now it's consolidating on top of this pivot. So right now you have to say that that's bullish. Commodities really, from what I found, at least the ETFs, they don't really play moving averages as much, just because typically the commodity they follow is going to move them more than, you know, a support of an individual stock. They're going to get sold off together more so, in my opinion. But right now it's consolidating above this, which I would consider bullish. Just gonna wait and see. You probably would do just fine with an overbought, oversold on one of these, but it is in an uptrend, right? So I would say that oil is still bullish. I like biotech. I like biotech, and here is why. One, it is biotech, draw this consolidation. Longer the base, the higher the space, right? Biotech broke out of a consolidation and went back 3 years, and it broke out of that. I mean, it was grinding through it earlier this year, late last year, and now it's holding above. That's probably a crappy trend line, but let's just draw it across here. Either way, it's holding above this, and yes, this is a big move right here, but let's go back to the monthly chart, and if you look at the big picture, you know, it's not as big as it looks if you have a longer term. I mean, look what biotechs can do from 16 to 100, down to 50, back to 100, right? So I like biotechs. I like the future of biotechs. They're acting right. They're showing relative strength. The difference between, one thing I'll say about individual biotechs, individual stocks really, really matter with all the trials you have. Semiconductors, they're acting okay in the short term. You can see they hit an all-time high, pulled back, but are now kind of creating this flag right here. So if this breaks out, I don't see why. I would think that the overall market will continue to charge higher. But right now, it's not, this ETF at least has not been easy, because every time it breaks to an all-time high, you get shaken out, right, and pulled back. So the best time to buy was probably a 10 RSI oversold. Jets. So airlines are breaking out of a downtrend. Whoops. Actually, daily chart's ugly. Let me look at the weekly chart. Yeah, that's a little better. So Jets ETF is breaking out of a downtrend right here. I don't know if that has anything to do with oil. I don't know if that is just, it's, time for them to just start making a move. But I'd say, to me, that's pretty bullish. But right now, you have the death cross going on, so it has some work to do to climb the leadership ranks. Hack, cybersecurity ETF, there's nothing to talk about. This thing just keeps heading higher. Yes, it chops, it grinds its way higher, but cybersecurity, I think, has a bright future. Let's look at regional banks. Regional banks have struggled. It's just kind of an ugly chart, just kind of chopping, but it still is, close 6% to an all-time high. At least this ETF is. So it's not rolling over, but it's not strong either. So if we get a pop in interest rates, I think this will continue to move higher. What else? The internet ETF dominates, and I'm sure there's some FANG stocks in here. I'm sure that's mostly what it's made up of, but it's done well. It's done really, really well, and technology is continues to push the market higher, which is why I was pretty positive when I saw financials and industrials pop for a little bit. But they're giving back a little bit today. But I like to do so much research on the weekend, get away from the noise, see what the weekly chart looks like, see what the bigger picture looks like. A lot of times I can make pretty decent decisions from that. So financials, I mean, this looks just like the XLF we already looked at, right? It is gonna go one way or the other. You could say it's trying to head this way. We'll just, hopefully this breakout will hold. I think that would be strong for the overall market. Copper miners, I mean, it's rolling over into bear market territory. You have the death cross. You could say it's broken every trend line we got. I mean, it doesn't matter where you draw it, it's breaking it. So copper miners are bearish. XME, metals and miners, are holding in there. They're holding in there, but they're just kind of hem-hawing around. And hem-hawing means going nowhere, so we'll just keep our eye on that. And steel is looking very copper-ish. Is looking like it's ready to crack. So commodities are just, they're looking weak. It looks like the dollar won, but I think there's a lot to be positive until there's a lot to be negative. So We didn't even look at breadth, but let's just look at that real quick as kind of something to finish on. So you have 71% of stocks in the S&P above their 200-day moving average, 72% above the 50, above the 20. It's hard to be bearish. It's hard not to be bullish, right? So I'm just trying to hang in there right now as long as I can. And then you have another breadth indicator, the high-low breadth indicator. There's a lot more accumulation in the S&P, in the mid caps than distribution as of lately. So you see right here, you can see small caps, lots of accumulation, lots of high lows, lots of high spikes. And then you have the NASDAQ 100, which, you know, the FANG stocks, you know, seems to never want to slow down. So the breadth is positive. You know, we're just kind of keeping our eye out. Maybe we get a few days pull back if you kind of follow that RSI line that we talked about in the S&P 500. So I hope this was helpful. Let me know if you have any questions.